Hey, how's it going, everybody? It's been a long time since I made a video regarding NIO or any just video in general. But I thought it was time to make one because while I haven't been following the company too much, I do follow the general economy. And this is because I've been looking for discounts in the overall markets. Um, and so when I was looking at NIO, just to get a little bit of information on what's going on with the company, um, I did see a few YouTube videos, YouTubers, and I did see a few articles that were quite bearish on the company. And I would have to say that while it does make sense to be a bit concerned with the company and what it's doing, um, it really depends on how you look at things or your perspective or your outlook or your time frame. So yeah, I just want to talk about that a little bit. Okay, so first of all, there's a few things that caught my attention. And I'm sorry if I'm missing something because I don't really follow NIO as much as I used to, just because while I do hold a big investment in the company, along with Tesla and a few other electric vehicle and traditional automakers, um, right now I've been more focusing on other companies like large cap and a little bit medium cap as well. Um, so with that being said, if I miss out some things, just keep that in mind. I mean, I'll follow like maybe like their quarterly earnings, but that's pretty much about it nowadays because the company seems to be doing fairly well. Okay, so um, the first thing I'd like to get into is the price wars that's currently going on amongst electric vehicle companies. When it comes to price wars, because prices tend to be sticky, you don't want to lower your premium goods or services too much, right? Because if you do that, especially with a company like Neo, where the goods are really premium and the services that come with it are also premium as well, it's going to come with a lot of costs that further down the line will have what will be tremendous. So what a company like Neo should be doing is keeping its prices firm, in my opinion, and then when the economy eventually picks up, um, yeah, keep maintain prices and focus on expansion. And if you really wanted, if Neo really wanted to compete in the price war in a sense, right? Like for you know penny pinchers or the mass market in a sense, that's what Neo should be doing, which is what they are. Neo will be offering its electric vehicles in the mass market through Firefly, and I believe they're coming in with two different types of sedans and I think it was priced something around 28,000 or 26,000 per electric vehicle, or a little bit shy of 30,000. And yeah, that's actually a very competitive price, especially when you consider there's also battery as a service as well. So with Neo, they're going to be able to offer higher higher quality mass marketed electric vehicles with the batteries as a service subscription model. And they're also going to be able to offer, you know, higher technologies and higher build just because uh, they can pretty much share any research and development and technologies and materials used from the premium section and then pass it on to their mass marketed vehicles. I think Tesla does something very similar, but the biggest difference is that Neo has battery as a service, so they can lower prices more. So if Tesla and NIO were to offer a mass market vehicle, NIO can cut prices down even further. So if I don't know, like the Model 3 was around 40,000, NIO could offer something substantially better than a Model 3 with better technology and better with a better vehicle build and be able to offer for maybe 20. maybe like 30,000 and then or 34 and offer battery as a service to cut down the prices even more to like 30,000 or even less. And then, with people who are more mindful of money, they might be able to consider things like the long lasting effects of battery as a service and how it can help vehicle retention, right? So, yeah, NIO shouldn't be cutting down their prices of their luxury just to compete with volume and delivery numbers from other competitors. That doesn't really make sense. Especially when you're looking at a long-term outlook, it's not a good idea for a company like NIO to be doing that, and it doesn't need to. NIO as a company has a lot of cash on hand. I think they can last anywhere from 3 to 6 years, depending on how they go on about expending their cash. So uh, it doesn't really make sense. Delivery numbers month over month isn't everything. And I don't know why people only consider that. It could be, they're speculator traders or something. But yeah, overall, it's like this. If a company forecasts to deliver, I don't know, 300,000 vehicles in 2023, okay? And, they missed that by 50,000. Yeah, that's a really big deal. But if they make up that loss in, I don't know, 2024, 2025, and 2026, and they make up these losses later down the line, then it doesn't matter because they're either they can hit those numbers at the expense of their margins, or they can, um, yeah, or they can just wait it out and then hammer down when the economy turns around. So, in my opinion, it doesn't really make sense. And if volumes were everything, then again, NIO should just keep its premium vehicles at a higher price and not divulge into price wars. And if they do want to compete for the consumer in the price war, they should just offer their mass market. And if they expect to unleash their mass marketed vehicles by 2024, then, well, that's right around the corner. Okay, so NIO should just do it that way, not through they're selling their premium electric vehicles for less. That sounds like a terrible idea, in my opinion, to enter a price war, especially with a company like NIO. With if you understand the company as customers, that's just not a good idea. Okay. Another thing is, I've seen that they're even doing a lot of investments on different types of research and development and expansion of the company. And in my opinion, this is also a really good thing because when there's a recession or an economic downturn, assets become much cheaper. So it's like this. If you buy a stock and you're during, it's like you're going through a downturn, or there's something going on that's not good in the economy, generally the stock will reflect that, or the because the business might not be doing so well, and maybe the stock's price will be really low. And so what you want to do is that you want to buy it then, and then when a company turns around or the economy picks up, the stocks will generally follow the health of the economy or the interest rates, which sort of reflects the health of the economy in a sense, like depending or on how you look at it. So anyway, so basically what NIO did was that they raised cash just like many other companies during the boom cycle, which was kind of artificially boomed due to interest rates and other factors as well. But yeah, so it's kind of like taking profit, right? They raised capital during an economic boom in a sense. Well, it's not really a boom, but when their market cap and their share price went up tremendously, they took profit. Okay. And so, in my opinion, it makes a lot of sense for NIO to be investing that now because it's like during an economic downturn or recession, you can buy things for pennies on the dollar, just like stocks, right? Stocks become lower, assets become lower, generally. And so there's a lot of companies that are going through bankruptcies or they're restructuring or they're just going through a lot of hardships right now. Maybe they weren't well equipped to handle an economic downturn that we're currently going through globally. And because of that, NIO can buy factories, components, pieces, research and development, and just overall expansion and make deals with other companies for much cheaper. So companies that maybe are trying to raise their scores in some sense, or they're trying to cut down their costs of production or just their general costs, but also looking to expand. Maybe they wouldn't have looked at a company like NIO before, but now they're more desperate in a sense. So, they're going to be partnering with NIO, or maybe like let's just say there's NIO can secure really cheap deals on goods or services or raw materials or contracts or research and development, or they can acquire other companies or invest in other startups and things like that, which would generally cost more. Maybe in like 5 years ago, when the economy was somewhat better, um, and they can start owning things. They can start buying things up in the global supply chain, and they can start buying, yeah, pretty much just like increase their portfolio and expand the company, which maybe would have cost substantially more when the economy is doing well. But yeah, it makes sense, right? It's like buying stocks during a downturn. Um, Stocks generally become cheaper, and they kind of bought the dip when it came to like research and development and expansion. So to me, it's such a good thing that NIO is buying up and spending their cash, because also you need to consider like this. There is a saying cash is trash, okay? But cash is good, but there's a lot of inflation going on too, okay? And despite whatever the Fed says, we all know that inflation's a really big deal. And so it's the same thing with NIO. You don't want to be holding on to too much cash. You're going to want to spend as much cash and keep your company afloat at the same time. So manage your financials very well, but you're also going to want to expand and buy things when they're cheap. So this will all have a long-term effect that are positive for the company. Like here's an example. Maybe NIO had a contract with a raw material supplier, and it costs, I don't know, $1 billion for 5 years. But now the raw material supplier can sell it to NIO for 400 million, because maybe the other consumers of the raw materials are no longer there because they went bankrupt, or maybe there's a contract for a factory of some sort, and maybe they're selling for 2 billion, and now NIO could buy it for 1 billion, or just things like that. So it's always important to look at like the partnerships that are going on if you're really into the company. Um, what else is there something on my mind? So yeah, it's good that NIO's spending a lot of money, and they should be investing a lot of money right now, because it's like buying the dip in research and development, assets and expansion. So yeah, you want to do that. It's as if you were to have cash, and then you have a stock market dip, and then you don't buy it. Like, you don't buy the dip. That doesn't make any sense. And then you buy it all-time highs. Doesn't make any sense. It makes a lot of sense to me on why NIO is buying up, investing into even I saw the investment into nuclear fusion, and that makes sense because of their battery as a service technology, or their battery tech. You're gonna need that for electric vehicles to power a grid, or to power electric vehicles. So maybe their investment would have costed, I don't know, like substantially more, during a economic growth phase. So yeah, so NIO should be expanding and investing and growing the company's infrastructure much more now while things are cheaper. So in my opinion, I think what's going to happen is that NIO will invest in the mass market in 2024, right? And they'll focus on that to compete with the lower end and the mass market, where they're more price conscientious, and then use their keep premium vehicles the same, right? Because it doesn't matter if they deliver 6,000 or 5,000, but then they end up doing 15,000, 20,000 later when the economy picks up and the consumers are more willing to spend their money. Because you have to also think about like this: if you're not happy with delivery numbers recently, well, the average consumer is they're aware like, okay, new vehicles are coming out from NIO. They're revamping their vehicles as well. They're on newer platforms. There's more research and development, newer models. So what's the point of buying electric vehicles now? They might as well wait, right? So yeah, I can see why there's a there's a dip in the overall deliveries, and you've seen this. It's a trend if you look at the previous years. It's always around this time of the year when vehicle numbers dip, but year over year in the aggregate, the numbers are pretty okay in my opinion. Actually, very very good when you consider that this is a startup company. And so what you want to do is that you just want to make sure that the overall deliveries are still, I don't know, they're increasing. But I wouldn't worry about it too much because we are in an economic downturn. The Chinese consumers and overall consumers are waiting for the newer vehicle to come out. And um, yeah, it's just that it's not something that needs to be done today or tomorrow, but when is the best time? It's like if you had like a bakery in a sense and you had a 100 donuts, is it better to sell the 100 donuts today where you get $1 for each donut, or tomorrow if someone can buy it for $5, right? You might want to get the $5 one and just wait. Yeah, it may not look good on your day to day. You're going to go home and complain about how sales were bad, but the next day it'll be substantially better times five. So yeah, these month to month deliveries, I wouldn't personally be looking at them too much, unless you're a trader, but that might not even make sense either, right? Because investors and traders may also consider like the larger time frame or the overall macro environment. So moving forward, I want to talk a little bit about the Fed and what do I think. So I think it was about a year ago or so, I made a video regarding the stock market, and I still think it's going to be a V-shaped recovery. It's not going to be what um, some people suggest is going to be like the 1980s um, where we had an overall crash, and where we had a crash and stocks just lagged for a long time. No, I disagree. We will see a V-shaped recovery, and we're already seeing that in the markets. I mean, look at the Nasdaq, look at the S&P 500. Yeah, the Russell hasn't been doing so well, but you know, overall, the market seems to be picking up pretty fast. I mean, relative to like the 10 years that people are expecting stocks to stay down. Um, and there's a lot of reasons for that, like just with the monetary policies, how stocks work nowadays, with things like advancement technologies, and how stocks are valued, and the necessity for stocks to stay at a certain price, and how they're tied into our 401k and pensions, and just how the overall global economy is structured. You just can't change that. So that means that if we did expect, or if some people did expect, like a Great Depression in stocks, or like these substantial lows, how possible is that? Like, if you were to do that, how many people die because of that? Because they don't get access to their 401k, pensions, retirement, dividends. How many people are going to be financially destroyed because of that, and then die because of that? So you can't really have that unless you really understand like what's going to happen to the demographics of each country if you were to have like assets and stocks to remain low like that. It just wouldn't make sense. So it's kind of like, okay, it's like the thing with China and the US. They're not gonna have a war, because if they did, that means world it means world destruction for everyone. and maybe they have like, yeah. So it doesn't make it doesn't make sense. So um, we might see the Fed slowing down the rate of interest rate increase, but look, regardless of the interest rate increase, there is generally a lag effect. So that means even if we don't see the effects now, it takes time for these things to be shown and reflected in the real market. Um, so it's like, right? Because it's like if you were to, I don't know, take out a loan for a mortgage at these current interest rates, maybe you won't feel the effects of it now because you have a lot of cash, but maybe in 1 to 2, 3 years when the higher interest rates and the cost to borrow are start really when you start when your savings are gone and you start spending high due to the high interest rates and the cost to borrow, then you'll see like the costs and what it's doing towards people looking to borrow money due to high interest rates. So I don't think these high interest rates are sustainable. I think we do have to cut interest rates eventually. So I do see like a V-shaped recovery. And another thing to understand is that large cap, especially large cap tech stocks, have done very well, but not even large cap tech stocks. It's even the hospitality and travel. If you actually look at some of these hotels and resorts, they've maintained prices very well in their stocks. So, like Marriott, for example. But anyway, my point is that these generally safer, they're called safer, right? Safer large cap stocks. They generally lead the markets and then followed by medium and then small caps. For because they're supposed to be in a sense more speculative. And so yeah, you're gonna see if the large caps do well, then the medium caps do well, and eventually the small caps will pick that up as well because, well, eventually if you're an investor and you're trying to look for value, the large cap might not have that if prices remain high for the stock. So yeah, I do think that overall, comparing NIO to a lot of electric vehicle companies, the just based off the market cap and the financials and the overall prospects of the company in a 2 to 5 year outlook, NIO just seems like a much better company than a lot of the electric vehicle companies. But then yeah. So I I guess what I'm trying to say overall is that the share price currently isn't necessarily dictated by the company's immediate actions or whatever their current conditions are. It could be more due to other circumstances such as interest rates or how easy it is to obtain money or just the general outlook on the economy or US and China tensions. But there's a lot of catalysts that can break this, but overall yeah. I do have more things to say, but now's not the time. But you know, I would expect positive things to happen if Russia and Ukraine were to, even if they're to continue their war, if the media just drops it. So yeah, with that being said, I hope you have a good day. I have much more things to say, but perhaps I have to sit down and talk about it and put it on paper rather than just speak whatever's on top of my mind. But to me, it makes sense on what the company's doing. And just because someone's critical of the company, it doesn't mean that they're necessarily right. And I've seen a lot of YouTubers and articles, especially these YouTubers, they'll talk about or criticize a company, but it's very surface level analysis on the company. I mean, so is mine, but they don't really consider many things. Like, just look at delivery numbers. Like, I saw a Felix Financial video where he's like, oh, the delivery numbers weren't good, and that's not good. So that's not good. And then he pumped his course. So it's like, is that really that good of analysis? Or a Mr. P video where he gets anecdotal evidence based off what a NEO manager says. Is that really that good? I don't know.